Matt, good morning and welcome to another edition of Gold Matters. Thank you for being here.
Always a pleasure, Johnny. Lots to discuss.
There's so much to discuss. Hard to know quite where to start, but in the 20 to 25 minutes that we've got available to us, I thought it would be a great idea to look at gold and silver through the lens of three other asset classes and the signals that the bond markets, commodity markets, and stock markets are providing for us. We know that the fundamentals are intact, that we're in this period where decades of financial assets are now going to be moving into hard assets, the need to preserve wealth through hard assets, given debasing currency is the fundamental that is certainly in train. But I do think what's happening in other asset classes today is offering clear signals as to what is coming in the future. So before we move into that, I thought it was worth just quoting Kirill Sokolov, who last week said the following, and I think he just frames the world very well at the moment. And he said, we're going to have big inflation and bond yields are going to rise significantly. As a result, capital will migrate from the $300 trillion in fixed income securities and other debt around the world into hard assets, which is the best place to preserve value. But that flood of money would be like the Niagara Falls trying to flow through the eye of a needle.
Back.
The Fed has a long history of sacrificing the external value of the dollar to focus on the domestic economy, which has unsustainable imbalances, in which case hard assets will soar, led by gold, silver, and copper. Discuss.
That's an easy one. We're done. Now they're all connected.
Over to you, Matt.
Yeah, they're all connected. It's fascinating. Boring things like bond yields, the markets, inflation, debt, the massive move to hard assets, which you're going to talk a lot about. I know because you've had some interesting discussions, you and I off camera, that are really helpful. But I mean, when we look at the bond market as one of the key signals here, and he brings up, of course, it is the thing, and it's all connected. It's connected, of course, to gold as well. And trying to make it simple and not boring, gold from 1,500 to 5,000 in the last 5 years is extraordinary, but this is something that is not driven by just wars or tariffs or tweets. It's really driven by debt. And gold's rise reflects the tanking trust in broke nations and their failing monetary systems. And that's reflected in debt markets, which are the bond markets. And as debt levels become comical and demand for IOUs from broken governments falls, the yields rise. And those rising yields are many things, but ultimately, Johnny, they reflect distrust. And at 40,000 trillion in debt in my country, in the US, this kind of obnoxious, criminally negligent debt only works at low rates. And this low rate environment can only be achieved by some form of yield curve control or money printing to the moon. In other words, to your point above, currency debasement. And currency debasement is a massive tailwind for secular rising gold. Regardless of the fluctuations in the gold price, the tailwinds are inevitable and powerful. And then in my country, again, we're using it as an example because it's the home of the world reserve currency. It's the home of the US 10-year. It's a key bond and it's a key currency. And my country is running current account deficits at 7 to 8%. And the bond yields that reflect this distrust in the Uncle Sam bar tab or sovereign bonds in general are rising. And what's scary, Johnny, is this is not just a US problem, it's a global problem. And the chart I'm going to bring up here, which we'll share together, I think is in many ways the chart of the year. And what this chart is showing is that the 5-year annualized return for aggregate global bonds is the worst on record. And I think it's worth repeating, the worst on record. I think what these rising yields are, I call them rising shark fins, they are indicators of growing distrust in broke countries, and the bond market is the signal. I think, Johnny, that bond markets are eventually going to snap. There'll be a great snap event. You could call it default. In terms of the U.S. markets, the U.S. 10-year and the sacred 10-year Treasury, I think the U.S. will likely avoid, open default by debasing its currency via monetary expansion, the debasement trade. In a lot of ways, we've already defaulted because our inflation, misreported as it is, in actual terms, is much higher than bond yields. So we're effectively giving you a bond that's losing money. I think Bissett might even go to a soft default, as Jeffrey Gundlach said, and just control the yields and extend the duration. But that's wonky. The bottom line is our bond market is distrusted and yields are rising. That makes the cost of debt brutal, and eventually something breaks. And Johnny, I think the first area to snap could be in your own backyard in the UK in the gilt markets or in the European Union in general.
Yeah.
The ECB cannot bail out all of Europe. It has horrible demographics. It has low growth and productivity. And so us gold bugs are not really the kooks. In fact, the gold bugs are the rational human beings today. They see the inflation, they see the debasement, which brings me back to you and your original point, some of the data you have, Johnny, on this relationship between CPI and hard assets. And I'd really like you to share your thoughts on that because I think they're pretty extraordinary.
Yeah, I will. And just to bring the conversation back to sort of what's actually happening in the real world, Matt, as opposed to what's happening in markets with, financial jargon.
Yeah.
If you were to pick up, the front page of your London Times newspaper today,
Yeah.
you'll see that the UK Treasury, because of food price inflation, is now looking to cap food prices from the supermarkets. This is extraordinary, Matt. You,
Desperation.
you and I, we're of a certain age. I was a young boy in the 70s when we had the last period of proper inflation and
Yeah.
proper stagflation. Never did I think that we'd be in a position where the UK Treasury would be saying to supermarkets, you have to cap your food prices. Now, there is a precedent for this, and that's in Latin America. And when this happened in Brazil, well, guess what happened?
Yeah.
The shelves were out of food,
Yeah.
right? And it didn't
Yeah.
end well. Okay. But this
Yeah.
shows this is a real world example, Matt, of the desperation that is now coming in from governments. And let's be clear about this. The Straits of Hormuz are still closed. Right? Even if they open tomorrow, the lag effect from the
Right.
inflation that's being caused for food is material. It's months. Okay.
Yeah.
And for every day that they remain closed, this issue is going to get bigger and bigger and bigger.
Yeah.
And that is exactly what the bond markets, as you rightly highlight, are signaling, not only in the US, in Japan, in Germany, and in the UK. It's global, right? The debt issue is a global problem. But just from a real world example, that really caught my attention this morning and is a really scary indicator of this inflation shock that is coming in the second half of this year. But
Well, the
just
developing countries, the banana republics of old, reflect the developed countries today, from the shopping stores, the shopping markets of the UK to gas lines here in France. And we even have limits on how many liters we can buy. These are all desperate signals of the so-called big boys acting like banana republics because our balance sheets and our debt levels have become so embarrassing. And that, again, leads to the inflation and the commodity moves that you have some great insights on. But it
yeah,
is extraordinary. The real world experience is now undeniable.
yeah. And so let's just focus on this particular chart here, looking at the correlation between commodities and CPI.
Yeah.
And for me, this tells you all you need to know. What it shows going back to 2010, 2011 in this chart is the correlation between the prices of commodities and CPI is incredibly tight. Okay. And what you can see now is the commodities chart has gone vertical, absolutely vertical. And
Yeah.
that is a leading indicator of where CPI inflation is going.
Mhm.
And as I said, for every day that the Straits of Hormuz remain closed, then this makes that gap that you'll see
Right.
here between where commodities and where inflation is today, it's going to make that close much, much more quickly.
And you see,
And
Johnny, with this inflation, do you see it in the stock market as well, though? And we got to talk about the stock market and how that applies. I definitely want to get your thoughts on this immortal S&P, Dow, and Nasdaq, and other markets because that's
yeah,
interesting too.
yeah, and I think, look, thank you for raising it. We've talked about the bond market. Hopefully, this chart is very clear about
Yeah.
commodities and what that is signaling. So we've got the bond market signaling big inflation coming. We've got
Yeah.
commodities markets signaling big inflation coming. The conundrum has been the stock market,
Hmm.
and clearly, if we just take the S&P 500 as the best example of that, um, it's essentially seven stocks, right? The Magnificent Seven or 10 stocks
Right.
that effectively driving the stock market to all-time highs, both in absolute terms and in valuation terms.
Yeah.
Um, and the rest of the market, the other 490 or 493 stocks are doing absolutely nothing.
Yeah.
And they are reflecting, more the real world economy. So you've got this highly concentrated market, a market that is so concentrated that we haven't seen this level of concentration, well, frankly, ever. But the last time that we did was in the year 2000, and we know what happened
Yeah.
after the dot-com bubble bust in 2000. The Nasdaq fell what 92%.
Yeah.
And so, we've got this sort of cartoon character, I feel, where the stock market, that character is sort of running off the edge of the cliff, but it just simply hasn't fallen yet. But it's
It's a
being
great
driven
image.
by it's
I've had
being
that
being
image in my
driven,
mind.
but it's being
It's a great
driven by
image.
by
Yeah.
just literally a handful of stocks. And heaven help that market if there's a profit warning from one of these tech stocks, or the AI theme doesn't produce the productivity miracle that the valuations of these stocks are suggesting. So, but just to step back and see the bigger picture, maybe we should refer to the Warren Buffett indicator, the greatest investor of all time, and what he would say about the stock market today. And his indicator that he looked at was always looking at the value of the US stock market. That's the Wilshire 5000, so the broadest metric of the stock market versus GDP.
Yeah.
And you can look at this, going back 100 years. And
Yeah.
today, that on that metric, we're at 230%, right?
Which
So
is the highest ever.
the
Yeah.
value of the stock market, the US stock market today versus GDP at 230% is at an all-time high. But crucially, here's the point, Matt, that metric is two standard deviations above the trend,
Right.
meaning that we are so far above where the average of that metric is over the last 100 years, that this has actually only happened twice since World War II. And that was at the end of the 1960s and in the year 2000. And guess what? What were the two best assets to own for the next decade when
Drum
we hit
roll.
that
Yeah.
level? Gold and silver, right? So that's where we are today in with stock market valuation. It's a very, very dangerous place to be
Yeah, I
investing
want to
on any
chime in with
historic
some.
metric.
No, these are excellent points, Johnny. And the classic Buffett indicator of market cap to GDP is really fundamental. But I think another classic Buffett indicator is the fact that Berkshire Hathaway is nearly 400 billion in cash right now. He's not trying to time this balloon. He's just getting out of its way. I think that going back to your original points earlier in the conversation, what's happening on the ground, what's happening in the real world, the University of Michigan Consumer Sentiment Index is at its lowest in history. It's at the bottom 1%. And yet stock markets are ripping to all-time highs. The disconnect between this Wall Street balloon and the Main Street reality from London to Lincoln, Nebraska is pretty startling. And it's kind of out of sight, out of mind. When I look at the stock market, in addition to the points you've made, I mean, look at it. You've got Putin using words like nuclear. We have headlines in Gaza, Kiev, the Strait of Hormuz. Nothing seems to impact this market. It's a very Pavlovian market where bad news is good news. As long as there's liquidity expansion or the hope of liquidity expansion, nothing seems to stop this market. And again, I've said so many times cryptically, you could have a mushroom cloud over a major city in America, and the markets wouldn't bend a bit as long as they knew the Fed was printing money or accommodating the markets. And the irony is the solution to keeping this bubble forever immortal is actually the problem. Because yes, you can make every dip a V-shaped recovery by expanding the Fed balance sheet or creating credit expansion or debasing the currency, but you kill the currency to do that. In this stock market, which is really a central bank market, it's so far from the plow now of free price discovery or the capitalism we learned in school. It takes us back to the bond market too, because we got to get back to bonds because those rising yields, those rising shark fins represent the cost of debt. And the US markets, we all know the stock buyback schemes that were once illegal and are now legal again. Rising rates in the bond market kill equities. We saw the most obvious sign of this, on Liberation Day back in April of last year, which no one talks about anymore. It gets past the Trump tariffs, good or bad, smart or genius, 3D or 1D chess, and it just looks at one simple indicator, again, not discussed. But in April of last year, when we tried this tariff thing, which failed, of course, we had to taco it. But regardless of the politics, what we saw when we announced those tariffs was that stocks and bonds were falling together. And I'm not an insider, but I have no doubt that Scott Bessent walked into the Oval Office and said, Donald, we're not as strong as we used to be. We can't prosecute these type of trade wars, these type of actions because we're too broke. And I think in this stock market, there's a million needles pointing at this immortal market, Johnny. I don't know. No one really always gets the right needle. I think Jeffrey Gundlach is probably correct. I think many of us in the risk asset space, you're a banker, I came from hedge funds, we know they're all correlated ultimately to hard assets and to gold at the end. In my opinion, and we could all speculate on this, I think like in 2008, it'll come from the credit markets, it'll come from the private markets. Private credit is totally illiquid. There's billions in gated redemptions. There are funds in the private credit space which are borrowing to pay investors. So they're basically adding leverage to already bad leverage. And I always use the joke of Harvard, the smartest guys in the room, their endowment. They have a massive private credit book that they can't liquidate. So they're borrowing billions because even Harvard can't get liquidity on its endowment's private credit book, which is, again, just a bug looking for a windshield. We saw it in subprime in 08, 07, 08. I think we're going to see it in private credit, but it's academic. Any number of things, black swans, white swans, gray swans, private credit, public credit, private equity could bust this immortal stock market led by seven names. But it really is irrelevant because mean reversion will come back. We're not here to time it. We know the bond, the stock, and the hard asset commodity markets are screaming signals of inflation. We know that the debasement trade, which we've been writing about for 10 years, is now a headline in Wall Street. But it's just the debasement of the currency. And we get back from all these complex themes, which are not that complex. It's, hard assets, bonds, risk assets, stocks. But we get back to the simple thing. Currencies are melting. And the antidote to that is an anti-fiat asset. You and I both agree that it's probably not going to be Bitcoin. That's another rabbit hole. But as you indicated, the last time we saw these kind of signals was right before major moves in gold and silver, and gets us right back to our primary asset. We're not apologists for gold and silver. We see the direction of the hockey puck. We see the math signals today, the historical signals yesterday. It's not really important to us what the gold price does on a given week or month or quarter. It's secular direction, and its secular direction is based on the clear direction of paper currencies. So I don't know if you have any closing thoughts, Johnny, but I think these are really great indicators you brought up, and I think we're in the best asset class you could be in for where the history is going and where the math is going.
Yes, look, just in closing, look, what you and I do day to day is simply try to analyze risk and protect and help clients protect their wealth via owning physical precious metals outside the banking system. It's very, very straightforward. And, given the glaring signals that we now have from, the biggest market in the world, the bond markets globally, and now from commodities markets, it does feel that there is an accident waiting to happen. And maybe it's going to take some form of accident that you can never predict where it's going to come from, Rather like, no one saw LTCM going bust during the Asian crisis. Okay,
Right.
when everything was going on in Asia, well, suddenly LTCM's gone bust and needed
Yeah.
rescuing. But what's so extraordinary to me is that even as we sit here today, given these obvious concerns in the world, they're on the front pages of our newspapers, and now the markets are showing us ownership of precious metals is still incredibly low. Half a
Yeah.
percent of all financial assets today are still in gold, and the multi-decade average was 2%. So
Yeah.
for me, it is amazing that,
Yeah.
to get just to back to the mean, you need a quadrupling of demand,
Yeah.
um, at a time where debt's never been higher and risks have never been higher, and these are glaring red flags that we're seeing in other
Yeah.
in other markets. So perhaps that leads nicely back to Kirill Sokolov's analogy that at some point it's going to be like the Niagara Falls trying to get through the
Right.
eye of a needle,
Right.
as pension funds, institutions, wealth management firms realize that they have to protect their portfolios by having exposure to hard assets. So that's all to
Yeah.
come.
Yeah, Johnny, it's fascinating. I mean, here we are. You're talking about the small allocations relative to the signals. The retail investors or the Main Street investors are the last to always get the memo. It reminds me a lot of the subprime crisis in 2008 when a lot of the experts, including some little wayward funds at Morgan Stanley, were saying this thing's going to pop. We need to buy protection against this blowing up subprime mortgage crisis. And as mortgages were defaulting, the ABS index was going up, and everyone was in the trade that was going to kill them. And it was only a small handful of people who saw the trouble to come, and they made a movie called The Big Short out of it. I think what's going to happen, John, is they're going to make a movie about von Greyerz someday, and there's going to be some characters playing you and I. We've been trying to tell people to get gold. We'll have to find the right actors to play such extraordinary characters like us, but that will be something down the road. But I think the signals are very obvious for gold. It's sad that less people understand it. Certainly our clients do. We hope more people understand gold, period. It's such an obvious fat pitch right now in history.
Very good.
All right,
Matt,
buddy.
thank you. Great to have you here again, and let's do this again. Let's do this again in a couple of weeks' time.
Look forward to it, Johnny.